us now for more is Dino Aquino, VP and Head of Fixed Income Trading at Security Bank Trust and Asset Management, and Victor Abola, economist at the University of Asia and the Pacific. So good to have you both, gentlemen. Dino here in the studio, and Victor, a common mentor for us both, maybe in different decades. Good to see you.
Morning, Mr. Aquino.
All right, good to have you both at a very critical time when inflation figures are falling. And I know that you made a bit of a change there, Dino. Take us through that thought process there. You nearly got it right.
Yeah,
but you changed your mind at the last.
I changed my mind yesterday. I chatted you. My original estimate was actually 1.3. Then I just made a last-minute computation yesterday. Then I realized it was June. So, so I was originally correct. But
all right.
yeah, but
so that's
still,
the technicality there.
But as mentioned, it's still the lowest since 2019.
It is, and you took of particular interest the movement in the bond market as well as the Philippine peso.
Yeah.
We've seen a bit of strengthening, but the bond market barely changed, as we saw it a couple of seconds ago.
There's a word to describe the bond market right now. It's like a groundhog day. Months since February. It's more of the global implications on the uncertainties. If you look at our fundamental economic situation, it's actually we're in solid footing. Inflation's going down, growth is decent, the peso is strong. So in reality, yields should be a lot lower than where it is right now. But because of the uncertainties with regards to the Trump administration, the taco trade. I don't know.
Right.
The taco trade.
Trump always chickens out.
Yeah,
trade.
the taco trade.
Coming from the Trump put.
Yeah, and then, of course, the uncertainty with regards to when will the Fed reduce policy rates. Because I think in terms of decoupling, the Philippines, the tightest we actually decoupled from, the tightest spread we had from the US in terms of benchmark rates was around 2022, which is around 75 basis points. So I don't think they can actually tighten further to 50 given the uncertainties. But in reality, we can actually decouple if we just look at the solid fundamentals locally.
Well, let's ask Vic, because Vic, you go a really long way back. I mean, when I was just starting as a reporter, you'd already been a mentor there. Take us through your thoughts about that word decoupling, because that's a concept that I hadn't really taken up since globalization came to be the operative word. How does it appear to you now that inflation is not a problem, but growth is? And how much of an impact really is whatever's happening in the U.S. to us that is least exposed?
I think that there's been too much focus on the United States when the fundamentals in the Philippines is actually much better, and the economy is slowing down. And I think that the central bank BSP has been too timid. My projections right now will average below 2% inflation rate for the year. So you're below your target, and why is it that you're still keeping interest rates high? That's preventing a lot of companies from borrowing, and also our real estate sector cannot recover because it's too high. I posted in our publication that I expect 50% 50 basis points cut from BSP. That is to be June, July at the latest. And that should spur the economy as well as the bond and equities markets. I think that we're seeing very high 10-year yields in real terms. Real means nominal yield, 6.3 minus 1.3% gives you 5%. That wasn't there since, 2009.
Okay, so the word there is timid. If you were the central bank governor, Professor Vic, how would you do it on June 19th? Would you go for 50 immediately, or would you go in increments of 25?
As Mr. has pointed out, there's uncertainty, but the uncertainty does not lie in inflation. The uncertainty, because inflation is not going to be a problem. Oil prices are low. The world economy is slow. And then we'll be flooded with Chinese goods that cannot enter the United States. So where is the inflation going to come from? Nowhere. And that's why the focus is to be on growth. which we have been underperforming in the last 2 quarters. Um, and, interest rates are, policy rates are so important because as I said, they are 15-year high. So, what's the point? I mean,
All right. Well, point taken.
uncertainty there is, but
Yeah.
it's not on inflation.
Point taken on growth, but let me ask Dino because we've been tracking the interest rate differentials for one, so that's kind of a dependency there
Yeah.
with the Fed. But then we see that we're growing,
Slower.
comparatively slower.
And we missed the target last year.
That's true.
Yeah.
So we hadn't really seen 6% over the
Yeah.
last 2 years.
Yeah.
But then when we compare ourselves to the ASEAN, we kind of look like we're in a
We're
solid
doing
place.
better compared to our neighbors, actually. But I have to agree with my professor on the spread versus inflation, because the historical spread between the benchmark rates and the inflation rate is 150 basis points. So if Dr. Abola is looking at a below 2% inflation for the rest of the year average, 5% policy rates is really too high if you consider how low the inflation average is. So that could entail further slowdown in growth, which we can't afford I think, for this year. Given that it's an election year, we have to show some strength in terms of growth.
And taking a look at the bond market, we're rejoined by Dino Aquino, the VP for Head of Fixed Income Trading at Security Bank Trust and Asset Management, and Victor Abola, economist at the University of Asia and the Pacific. Let's take a look at the bond market there. I know you pulled out your phone. The belly of the curve is very interesting because you're seeing the movements there, but we're not seeing much of the movement in the 10-year, which we thought we might see some movement.
The belly is interesting because, as you mentioned, when the BSP will reduce policy rates this June, the immediate impact would be on the short end of the belly. So the duration fear is still there, especially with the U.S. I know you've been hearing the U.S. 30-year flirting with the 5% level. So it's steepened quite a lot. It's similar to our own local bonds, where the 20-year is actually steepened to around 6.6%, and the 10-year is hovering at around 6.3%. And again, given that our inflation is 1.3%, that's a very, very huge gap in terms of carry. So I think that's a very attractive level if you ask me, at 6.3 versus a inflation average that's at below 2%. That's very attractive for me.
And it also validates the decoupling story. And when you look at a wider spread there, and Vic, we've been talking about the European markets and how they've really decoupled with 9 rate cuts there. Even Trump saying the Fed's got to do the same. But then again,
he tweeted yesterday.
But it only shows that if Europe's decoupled, then Asia could as well.
They could,
or is.
if they want to.
And is the Philippines in a good position to do that?
Yes, I think so. I believe so. We're in a good position given our inflation outlook, and of course, Dr. Abola mentioned that our growth needs to be stronger. I think in terms of growth, we're doing better than our neighbors. But if our goal is to achieve a credit upgrade, then our growth has to be really, really strong for that to be achieved.
Right. Vic, I'd want to ask you then. I mean, you did cite some uncertainty there. I mean, the imports coming from China and that flood of imports, quite a concern. What can the government do right now, proactively? As we know, we can decouple, and we're going to get some help from the BSP, although you wanted them to be a little bit less timid. What can the government do in this case to make sure that they achieve at least the bottom end of their forecast of 6% growth?
The first thing they could do is really to cut aggressively policy rates by 50 basis points, and that should help a lot of the investors, particularly in the real estate. And then they should rebuild the dollar reserve, because all of the increases in our dollars in the past 3 years have been based on borrowings. That's not a sustainable strategy. We have to buy dollars because you have a weaker peso, the OFW spending has a multiplier effect of 2.5. So it's not like in other countries where a depreciation of the currency produces contraction in the economy. It's not. In the Philippines, it is actually expansionary. And that is what we need. There was no point in really letting the peso appreciate so much in the past 4 months.
Are you concerned though? Because it's already appreciated 2.9%, so that's 2.9% less of a remittance for
Yes.
the overseas foreign worker abroad, remitting money home.
Yep.
So what is the sweet spot then for the peso, if not at the 55 to the dollar level?
I think we had already reached 58 now, and that was okay at the time, and why do you build reserve by borrowing when you can buy it from the market and keep it there at more or less 58, and so you benefit the economy in that way because from around 70% of the economy really depend on the currency movements.
All right. Just as a final point, Dino, as we do have to wrap up, how do we then trade? The belly of the curve is showing a lot of risk aversion there and a lot of safety, flight to safety.
Yeah.
What would you advise investors?
For me, I think it's an opportune time to add duration, especially on the 10 years and above, given how steep the curve is. The belly has had a good run. And I think moving forward, especially in the second half of the year, we might see the long end outperform the belly. Because in the first half, the belly outperformed the long end. So I think it's an opportunistic time to add some duration at this point.
Got that. Well, thank you so much for joining us. Really
Thank you
appreciate
again.
it.
Thank
And
you
to have our
again.
mentor online.
Hi, sir.
Thank you so much, Professor Vic Abola. Appreciate your time and
Thank
expertise.
you, Kathy.